You've probably heard the saying, nothing in life is free. And even zero commission trading platforms like Wealthsimple Trade and Robinhood in the US aren't really free. So in this video, I'll tell you how they make money off of you without directly charging you a commission. Welcome back to Steadyhand, where we empower you to better your financial future. Subscribe to the channel if that's something you're interested in. The list I'm going to take you through is not an exhaustive one. I'm going to highlight the main ways these companies make money. And their methods might not even sound very profitable initially, even the more controversial ones. But you'll want to stay on until the very end of this video because my last point will explain how these platforms are able to grow into multi-billion-dollar enterprises by using what sound like low-profit techniques. The bid-ask spread is the most basic way these platforms make money. It's simply the difference between the price you pay when you buy a stock versus what someone else gets when they're selling that stock at the same time. We'll use an example. Say you want to buy a share of company X. It'll have a bid and ask spread. The bid might be $99.98 and the ask $100.02. If you're buying it, you'll pay the ask, which is the higher value. Someone selling it at that same time is going to get 99.98. And that 4-cent difference is what the platform keeps to facilitate the trade. Now, the reality is that on large stocks like Microsoft, Apple, or Royal Bank, the spread is just a fraction of a penny. But it can be much larger on smaller stocks and also stock options, regardless of their size. Payment for order flow is a highly controversial topic, but a major source of revenue for trading platforms. This is when the likes of Wealthsimple or Robinhood receive compensation for sending customer orders to specific traders instead of going directly to the exchange. It helps trading platforms generate revenue, but it also raises concerns about conflicts of interest and potential pricing disadvantages for the average investor. Conflict of interest arise because it's hard to know if the platforms are indeed getting the best possible outcome for their customers. The traders that receive the orders may execute them at a slightly less favorable price to the best prices available on the broader market. In fact, payment for order flow is so controversial that it's not allowed on Canadian stocks. But that doesn't stop Canadian trading platforms from doing it on US stocks. Now, to me, currency exchange is a sneaky way trading apps make money. This applies to Canadians investing in US listed stocks. First, the exchange rate offered is always horrible. It has some profit built into it already. Then they'll charge a fee on top of that. For example, Wealthsimple charges 1.5% currency conversion fee, but they're not charging you for a trade, so technically it's still zero commission. Margin accounts allow you to borrow to invest, and trading platforms charge you interest on the borrowed amount. It's pretty straightforward. Now, please be very careful if you're using margin. Borrowing to invest amplifies the risk in your portfolios. I've seen many professional investors blow themselves up by using margin. So for the average person to do it right requires a lot of thought and skill. Another way that trading apps can make money is by lending out your shares to short sellers. When someone shorts a stock, they're betting that the price will go down. When you believe that a stock price will go up, you buy it today and sell it in the future. But if you think the stock price will go down, you need to sell the stock today and buy it back in the future. So how do you sell something you don't already own? Well, short sellers are able to do this by borrowing shares from someone who already owns them, and they pay a fee to do this. And some trading apps facilitate this whole operation. If you opt in, you can loan out your shares to short sellers, and the trading apps will share some of the fees with you. There are other ways these platforms make money. Some collect revenue to promote ETFs or certain fund companies. They charge for research and market data. There also might be fees for administering different types of accounts. But the points I've described earlier in this video in more detail tend to be the major sources of revenue. On their own, none of these sound like big sources of money. A fraction of a penny on bid-ask spread, 1.5 on currency, not really eye-popping. But the way they make fractions of a penny into many millions of dollars is by encouraging you to trade over and over and over again. Those pennies add up. And to get you to keep trading, these platforms try to gamify the whole experience so that you're always buying and selling. And that's despite the overwhelming amount of research that has found an increase in trading reduces portfolio returns. These platforms make money by convincing you to do something that they know will lead to bad outcomes for most of their clients. It's like tobacco or alcohol. In both those cases, companies sell you the idea that you're going to have a great lifestyle despite knowing how hazardous it is to your health. These platforms are doing the same thing. They use advertising and hire influencers to show you how fun and easy it is, despite knowing how hazardous it is to your financial health. So if you are going to invest using these trading platforms, understand that, yeah, you might not be paying commissions, but you're still paying, just in a different way. Also, keep track of your overall portfolio returns and compare it to how the market does overall. Are you actually successful? Because people have a tendency to remember the time they had a winner in their portfolio and forget all the losers. So you should track your entire portfolio performance. And try to keep your trading to a minimum too. As I mentioned earlier, the research is pretty clear. Lots of trading leads to lower returns. Something we often say here at Steadyhand is your portfolio is like a bar of soap. The more you touch it, the smaller it gets. Now, if you've made it all the way to the end here in this video, then you might find this other video helpful too. I take you through the robo-advisor landscape in Canada and the US. These robo-advisors were the hottest thing, but we don't really hear much about them anymore. And let me know what other topics you'd like me to cover in the comments section. Until next time, happy investing.